today's session of Visual Jforex, I will be continuing with the demonstration of the algorithm development using the indicator named Average Directional Index (ADX), which we use to see the strength of the trend and then trade accordingly. So let us head to the Visual Jforex board, which has been developed by the Dukascopy Bank SA. Here in the prior session, I had done the instrument subscription, then the position amount was defined at 0. Then I also got these ADX blocks of the hourly time frame with different look-back periods, and then to look at the price action and see what kind of volatility is there. We are also relying on these historical candles, which are of hourly time frame, to pinpoint the exact entry point for the execution of the trade or placing the order. These 10 seconds candles will come handy, and then to define the condition for at least minimum price difference. I have also carried out these subtraction to look at the price difference between the last hourly closing candle value and the candle value which closed 5 hours back. So we will be using these two values. One is for the buy side and another is for the sell side. Now I will explain to you the logic behind the execution of the buy trade, which we will define in today's session. So whenever we want to execute the buy trade, we will look at the ADX value, and for that the ADX value should rise above 25 from below 25, and at the same time the last hourly candle close should be above the hourly candle close 5 hours back. So we will be comparing the closing values for the two historical candles using different look back periods, and then we will also define one of the minimum price volatility condition which is going to be necessary for the execution of the trade. So here this ADX value is going to be one of the conditions. Then this price difference is also one condition which needs to be fulfilled for the execution of the trade. So let us now head back to the Visual Jforex board. Here I had done this calculation for looking at the actual value, and for minimum value I will have to define it using the calculation expression and the pip size for the given instrument. In this case we are using the Euro USD as our default instrument. For defining the 10 pips, we will have to look at the pip size for the current instrument, default instrument, and since we want the minimum difference to be of 10 pips, I will have to create a new variable which will be minimum pip difference, and it is going to be 10. We will multiply this with the pip size A1 into A2, and the result of the calculation will be minimum pip values. Okay, so here this has been defined. Now we can start to add the conditions for the buy side, and again I will have to come back and add a couple of calculation expression, but for the time being we get started with the multiple action and then add if blocks for defining the requirements, and then as and when again required we'll come back to carry out some calculations. So I will leave some space for the time being. I am connecting the flow, but most probably we will have to disconnect it and then reconnect it later on. Okay, all right. Now for the buy trade we want the ADX value to be rising and it should cross 20 about 25 just recently. For that, we want ADX 26 to be above 25. You can see in the plotting, we get this ADX value plotted after the last candle closes, and then we will be using these values to look if there is a good enough momentum. So here first input greater than second input, ADX 20, it should be less than 25. First input less than second input. Then we want that enough of volatility to be there, and for that we will be looking at the price difference of the last hourly candle close, which is candle 21, and it should have closed higher compared to the candle 22 which closed 5 hours back. So here this is the price difference, and it should be greater than minimum defined condition. Okay, then all we have to do is look at the exact entry point, and for this session we will be working with the pending open order, not a market order. So for that we will also have to work with the buy entry point again, and for that some calculation will be required. Now here, and to define the exact entry point, I will also compare these 10-second values with the hourly value, and for that we need two more if else block, and here candle 23 closing value should be higher compared to the candle 21's closing. So we have to now take candle 21's closing value in both these blocks and compare it with candle 23 and candle 24. Okay, whenever price starts to rise above the last hourly candle close, we will see that system will place the order for new buy trade. But since we are not really going for the market open, the order will be placed in the limit format, which means it will be below the current market price. Here first input greater than second input. Candle 24 has look back period of 2, shift value of 2, so it should have closed lower. First input less than second input, and then here candle 23 which has a look back period of 1, it should have closed higher. So first input greater than second input. Now we need pending open. So here this is going to be by limit, and this time around I will also define the price, and also we will go with the dynamic stop loss and take profit. We will not use static values, predefined values. We will see what is the kind of volatility for the underlying instrument, and then depending on the difference which we have calculated already, we will define the stop loss and target price in the same terms. So we now want the order to be executed for the buy side as and when we see enough of volatility with the price rise. So that might happen any time, and for that the algorithm will be working day in day out. So somewhere here I think the price is also rising and the ADX value is also on the rise. So after this 11 GMT candle close, the order will be placed, and that is going to be 40% lower compared to the difference of this candle close and hourly candle which closed 5 hours back. So we will be looking at the price equivalent of the Fibonacci ratio. So whatever is the price difference between these two candles, we will be taking 40% of it, which is going to be fairly close to the Fibonacci ratio of 38.2%. For that, we have to create new variable now. We have already taken into account the actual price difference. Now all we have to do is find its 40%, and for that I will have to take calculation expression one more time, and as I had said, we will have to disconnect it now. And this difference needs to be multiplied by 0.4. For that, I will create a new variable which is going to be by execution difference 0.4, and this is A1 into A2 execution actual difference. Okay, and we need it to be deducted from the last tick price. So whenever the other conditions will be met, we will deduct this ratio which we have calculated from the last tick price. So for that, I have to take another calculation expression block, and there we'll use on candle. So we will use we can use on tick as well as on candle, so it won't make much of any difference. Last as candle, I think it will be better if we go with the bid instead of ask for the buy side trade. So here we will have to rely on its one of the individual price. So rather than that, we will take on tick price. Okay, last tick bid, and deduct the 40% of the price difference, and that will be the limit order price. So A1 minus A2, and this will be by execution price. Okay, So here this price has now been defined, and for the time being I am again connecting this, but for defining the sell side again we will need to disconnect it. For buy trade to be executed, the price now has been defined, which is going to be the 40% below, and it is the 40% of the candle difference of two hourly candle close values, the last one and the 5 hours back. So I hope you have been able to understand what I have done with these calculations, and then this creation of this new variable, and default instrument will remain as it is. For trade amount, I think 0.1 should be good enough. It is going to be dependent on the amount of equity you have. Slippage 2 pips should be fine. And then comes the question of defining stop loss and take profit, which we will define in the next session. For order validity, I think 2 hours should be good enough. So that we will define in today's session itself. So let me again carry out one more calculation. For that, the calculation expression block is going to be needed, and 1 hour has 3.6 million ticks. Since we are going to keep the order valid for 2 hours, we will have to multiply 3.6 million by 2 and add it to the last tick time. So the first is last tick time. Then we will need to create two more variables. One is going to be ticks, so it is 3.6 millions. Count the zeros properly. Okay, it looks good to me. And since we want it to be valid for 2 hours, one more variable will be needed, and this is 2. Suppose if you want to keep it valid for 1 hour, you have to just take 1. If you want to keep it valid for half hour, then you have to take 0.5. So you can vary this value as per your convenience. This is going to be A1 plus A2 into A3, and then we have to pay attention to the data type. Here the validity or order validity is in the long data type, so I will create the new variable here itself. I will name it OET, and its value will be derived from here. So whatever is the result of this calculation, that will be the validity of the buy limit order. So far so good. So now I have defined the order validity, and I will have to disconnect and join this block here, and again here. Okay, so for this session that's all from my side, and in next session I will be back to explain to you how we can define the sell side, and also in this block we have to define two more values, two more input values, the stop loss and the take profit, which we will do in the later on sessions. Thank you all for joining in. Do subscribe to the Dukascopy webinar channel to stay updated on the market development. See you next time. Till then, goodbye.